I get there in 2007. We have 175 properties. We're not making money. We have 175 properties, making no money, actually losing a little bit of money on this portfolio. We're like, how could that possibly be? Like, this makes no sense. But it was like, dude, we need to do this. Otherwise, the math is you're going to bleed out, right? Like, we were doing the math. We were just like, if we don't do this, we'll be bleeding out and in foreclosure in 3 years.
If you have a property that's like built 1900 build and you haven't done like a full renovation, you better be thinking like, hey, these maintenance costs are going to be higher than that 1996 build across the street. I've always thought that the turnover is the most important thing to like look at, because if you're getting like a turnover every year, you're not making money. You're going to be losing money.
This is all got to go. Like, there's an oyster bed foundation. Like, we have a problem. Like, Houston, we have a problem. Like, pound for pound in terms of like money made per hour, I don't think there's anything better.
What is Dominion's buy box? What is Jack's buy box? What does a good deal look like for you in today's market? Like bedrooms, bathrooms, ARV, like purchase price, first renovation. You just walk us through what a good, like, comes across your desk and you're like, we're buying it. We're adding it to the portfolio. You've mentioned a bunch of areas, so I appreciate that. But if you were like to target the best areas in Baltimore that you think you're going to see appreciation in, which areas would you target? Hey, investors, welcome back to another Real Estate Hackers show. Today, we have an amazing interview with Jack BeVier, co-founder of Dominion Group. And by the end of the video, you will learn how they scaled an 850 unit rental portfolio, the process they use to evaluate hundreds of properties quickly and easily, what metric they concentrate on to maximize ROI in their rental portfolio, what he believes is the fastest way to build wealth, and what strategy he thinks is the best in today's market, and whether their portfolio consists of more Section 8 tenants or market tenants, and why. So we'll discuss all of that and a bunch of other golden nuggets from Jack. So buckle up, enjoy. Welcome, Jack. That was a big intro.
Dude, thanks for having me. I really appreciate it.
I'm excited to kind of dig into your background, kind of uncover how you scaled or help scale a big rental portfolio. 850 units is large by any means. So would you mind just kind of starting off and kind of where you started in real estate, kind of that first humble beginnings part?
Yeah, sure. So my partner, Fred, started Dominion back in 2002, and he started it by himself with just some personal capital that he had gotten from selling a previous t-shirt business. Actually, he was selling t-shirts door to door in college, grew that for like 10, 12 years, exited that business, had a little bit of money, and started Dominion back in 2002 with the idea of having a real estate company, a property management company, and a lending company that all kind of like fed each other. That was like the original idea. And I actually met Fred as an intern when I was in college after my junior year. And so I interned for Fred, and he put me into the lending business, and there was like 7 or 8 people at the time in the company. And I just had a blast. It was like a super entrepreneurial environment. I actually got to do shit, and I wasn't getting coffee. I was like going through QuickBooks and making phone calls and like evaluating the loan portfolio. So, as a 19-year-old, I thought this was, super fun. And so I ended up finishing school, going to New York for a couple of years, did commercial real estate up there, like a finance job, and then called Fred for a reference. He ends up talking me into coming back down and saying, hey, it's 2000, at the time it's 2006. If you came down and did acquisitions for me, like we would, we'd have a ton of fun. We'd kill it right now. And in 2006, that was true, right? That was a great time to do that. So he ends up talking me into coming down. So I leave my New York job in March I come down to Baltimore in March of 2007. And like the day I got here, the market just like starts taking a dip. I got a huge learning lesson over the course of the next like 4 years, doing nothing but workouts, catching a falling knife as it related to real estate prices, saw tons of distress. And it led to a tremendous amount of opportunity, but it was a really kind of like difficult, crucible to teach me the real estate investing business. So Fred's really my mentor. He taught me everything that I know, and has also, become my partner and given me the rope to help build the platform, which we've been doing for the past 18 years together.
Yeah, no, it's an awesome story. When you came down, you started building the portfolio. Was there a reason that you guys stuck in Baltimore? Was there any particular thing about Baltimore?
I mean, it happened to be where we were. Fred lived in Columbia, Maryland, which is like half an hour from downtown Baltimore. I grew up outside of Annapolis, but had never really spent much time in Baltimore. So when I moved here when I was 23, that was really my first, 4 for it and first introduction to the city. So I was learning everything from scratch. The things we liked about Baltimore were, it was a relatively low price point from an entry perspective, which is attractive, right? You don't have to put all your eggs into like one house basket. You could buy a couple houses. We were buying houses for, typical deal was like buying a house for 30 grand, putting 30 grand into it, right? Like those were typical deals at the time. So you could get in at a relatively low price point, and then the yields you could get on the rental portfolio side, at least on paper, looked really, really attractive. So, if you went to the county, or if you went to other like kind of, primary, even secondary markets, you couldn't get the same rental yields. And as a result, the cash flow profile of building a rental portfolio was much more difficult outside of the city. So we could buy a house cash, renovate it cash, and then refinance. And then because we'd added value doing that renovation, we could refinance off the appraised value and get our hard costs back, right? So we could recycle our operating capital, go back out there and buy another house, like kind of classic BeVier strategy before I learned from Bigger Pockets, but it's called the BeVier strategy.
Yeah.
And that was the game was, find deals that were cheap enough that we could add value, refinance, and get our hard costs back out, and the loan and the rent from the property covered the loan payment, and just rinse and repeat and do that as many times as we could.
Yeah, you're talking about back then. We'll start at your beginning. When you came and you joined Fred as a partner, what did the rental portfolio look like? How many units did you guys have back then?
Yeah, Fred had gotten the rental portfolio. He'd grown it very quickly because financing was easy to get. We had a property management company, so we could just, it's just another unit to feed the property management company. He was buying basically turnkey rentals off of the previous generation of landlord in Baltimore who was getting out of the business because of the lead paint lawsuits. So like there was this, back before the mid 90s, there were 15, 20 landlords in Baltimore that owned thousands of properties. Like a small portfolio of that group was 500, and they owned like all of the rental properties. But then they started getting hit with lead paint lawsuits, and that caused them to, and then lead paint insurance stopped being issued, but the lead paint lawsuits continued. So it kind of chased out this like previous generation of landlords who had exposure to not having remediated the lead paint in their property. So from like mid 90s to the early 2000s, there was this huge exodus. So they were selling these rental properties, dude. You'd go to an auctioneer, you'd go to an Alex Cooper auctioneer ballroom gallery auction, and they'd sell 80 properties that day. And they put a picture of the house up on the screen at the front of the room. There's like 300 people in the room with paddles. Everyone's getting financing, right? Because it's like, this is like 2003, 4, 5, 6. Like this is like that period of time. And these guys got out selling to these landlords. They're selling to these folks. And they're selling properties for like 50, 60 grand, rented with a lead certificate that's a full risk reduction lead certificate. And the house is rented for $795. And the property sells for 55 grand. That was like a very typical deal. And they sold thousands of these properties that way. And there's lenders in the back of the room who will finance you for this. If you were doing any value add, you could try to refi off of like a $90,000 appraised value and try to get your hard costs back out. So anyway, sorry, long preamble, but that environment is what Fred came into when he started in 2002. It was like the run up of that. And so he was up to about 175 properties when I started in 2007. So there was like a sizable portfolio there. None of them had been renovated by us though. They were all like these like previously, they were the existing rental. You were inheriting these 750, 850 rents, all full risk reduction lead certificates, very high maintenance costs, relatively high turnover rates. It wasn't a stable portfolio. There was a lot of work to do. Over the course of the next 15 years, we re-renovated every single one of those, or re-renovated for the first time, every single one of those. But at the time, it was like, a way that you could get up to get a base up relatively quickly. So that's what we kind of walked into, is I had this base of assets to play with, to work on, but they all needed a lot of work. So it was a lot of work.
Yeah. And you talked about your strategy of a lot of times purchasing something, which is, you're not going to find anything $30,000 unless it's gross shell in Warzone today. But talking about your strategy back then, and if we're talking about like your buy box, it was like buy 30, renovate for another 30, and then your ARV would be what? You're looking for like 120 ARV, 100 ARV. Was there like if you can remember back then, like what kind of equity spread were you looking for after you did the value add?
Yeah. We wanted to get our hard costs back out, right? So it was like, if I was buying for 30, renovating for 30, I'm in for 60. I wanted to be able to get 70% loan to value loan. and get my hard costs back out. So whatever 60 divided by 0.7 is, whatever 90 grand or whatever that is like the minimum appraised value that we were looking for.
Mm-hmm.
We were also looking for, what I got taught to do is instead of calculating cap rate, which is what I had been trained to do, like I had like a, commercial real estate, background, which, you needed to bust out the Excel spreadsheet in order to calculate the cap rate and the debt service coverage ratios and all that. Problem is that like, that's a real pain in the butt when you're in your car driving around looking at 30 properties that day. Like you don't have time to like bust out the laptop, in the middle of West Baltimore and start calculating cap rates. So I needed a heuristic that I could do in my head. So the kind of the inverse of that is like gross rent multiplier. So we would use, and I still use gross rent multipliers based off of the monthly rent to just do the math quickly in my head. At the time, the target was like 50 times rent. So like if it was $1,000 a month rent, we wanted to be in for 50 grand. If it was a $1,200 a month rent, we wanted to be in for 60 grand. And that would give us enough spread that we knew that there was plenty of debt service coverage. So if we could get our hard costs back on the refi, we knew that the house could carry that much debt and spit off a couple $100 a month of net cash flow in theory, if we were in for 50, 60 times rent in that range. And the nicer location, you'd be willing to be in for a little bit higher gross rent multiplier. The worst location, the lower gross rent multiplier. And so that was like my heuristic for years, was 50 to 60 times rent, depending on the quality of the location. Today, it's more like 70 to 120 times rent is like the market today. It's gotten much more competitive, lots more investors out there, lots more sophistication in the space than existed 18 years ago.
Yeah, I love that simplistic approach. I mean, it's almost like your napkin math approach. Do you still use that today at all?
Yeah, that's what we use. I mean, when you're going out and making 50 offers on something, you need something you can do quickly. So it's kind of close enough,
Yeah, what's your multiplier that you try to stick to? Is it 70 or 75 or is it more than that?
There's certain locations that we just don't want to buy because we've found that like in too low end of locations, the tenants don't want to live there. You can't get tenancy duration that's long enough to actually make money. So like it looks good on paper, but you actually operationally can't achieve that 3-4 year tenancy duration that's necessary to hit your 10 cap rate, that the Excel spreadsheet tells you you're going to get.
Yeah.
So there's a certain segment of locations that we're just not buying in anymore. But kind of like where we start, which is kind of like Bel-Air, Edison, Edmondson Village, Allendale, for those familiar with Baltimore, like Govans, like middle markets in city. That's like we're targeting like 70-ish times rent, 70 to 80 times rent in those locations. You get into your more competitive markets like Parkville and 10 Hills and closer to the county line, we're probably getting up to like 90 times rent. And then if we're in the county, we'll be like 100, 110 times rent, which doesn't end up with much, if any, like real net cash flow. But we think that like those are very stable areas. Tenancy duration is very long. And, we're playing for home price appreciation there in a very stable market. So the risk profile of those deals is a lot lower. And so we're willing to have less cash flow off of those.
Yeah, I love that. There's so much there. And then do you have like a breakdown? I mean, if you could like napkin math this right out here, would you say like, hey, what percentage of your properties do you really go for cash flow and what percentage of your properties do you go for appreciation, or do you not even think of it like that at all? Like obviously you have to have some sort of cash flow to kind of keep the lights running, if we will. If you're a smaller investor, you can't go all in for appreciation unless you have a W-2 job.
Right, exactly. Yeah, it's like how do you where the rubber hits the road is cash flow of the business, right? Like you can't adding a rental portfolio is a negative cash flow exercise, right? Like even if you can refi and get all your hard costs out, all the soft costs are still costs, right? Like you still like have interest payments, have closing costs, pay for an appraisal, pay for insurance, interest reserves, and the construction overhead of like actually having renovated and stabilized that property. All those expenses, that cash has to come from somewhere, right? So we've never been able to just build the rental portfolio. We've always had to do other things that produced current income so that we could afford to build the rental portfolio. And like that has been a very difficult, constant struggle, constant thing we've had to manage.
Yeah, it's like a balancing act, right?
Yeah, balancing act. Yeah, that's what I'm looking for. But anyway, so in the beginning, I would say in the earlier stages of building a rental portfolio, it's very difficult. Unless you got a rich uncle or a W-2 job or something like where you have that solid source of cash flow, It's very difficult to add rental properties that are in these lower cash flow locations, these like nicer locations, more stable locations, because it's also harder to find deals where you can get your hard costs back out on the refi in those locations. Like you often these days have money stuck in the refi. You can't be, you're getting your target cost basis being 70% of value. That's a really hard deal to find in a nice location. It's more, in our experience these days, it's more often 80, 85%. I'm in for 80, 85% of value in those locations. And as a result, on the refi, in addition to the 15 grand of soft costs, I'm also sticking 15% of the appraised value into the refi. So I need even more cash to be able to add that property. So it's relatively easier in lower end locations to find the deals where you can get 100% of your hard costs out. So like we have, long preamble to answer your question, but over time, we started with tougher locations where we could always get our hard costs back out because cash flow, man, because we couldn't afford we'd run out of money if we were sticking cash into refis. And then over time, when we got to the inflection point where the rental portfolio was actually spitting off a little bit of cash, we started migrating kind of up market into nicer and nicer locations because we could make that work. We could take the net income from the rental portfolio and stick it into new refis in nicer locations. So over the years, we've kind of like migrated upstream because the cash flow of the business, allowed us, afforded us the luxury of doing so. That wasn't an option, 15 years ago. For the first 10 years of the business, that wasn't even an option.
Yeah. So I call that top grading. And I find that naturally in our rental portfolio, what I've done is naturally getting nicer locations, better properties, a little bit less cash flow. I know a lot of newer investors come in and they're like, hey man, I gotta recycle that. I gotta be able to recycle that money as fast as possible, like velocity of money. I've got to be able to, do the renovation value add and then pull the entire thing out, which is it's definitely hard, much harder in this market, pull the entire thing out, or even, the grand slam is you pull the entire thing out and you get like an extra like 15 grand. And so your
soft costs.
The velocity is just like going crazy because you're actually like making money off of your renovation, which in essence, you're adding value, you're creating equity there. And it's interesting that you say like, hey, you started out a little bit rougher areas, more cash flow, being able to recycle those, all your cost and get your money back out. When we say recycle money and then put it in the next deal to kind of redo it, repeat, recycle, repeat. And then as you've grown, and you have a little bit more diversification of like, hey, if this property doesn't do as well, it's still okay because the portfolio, at least this is what I find, the portfolio kind of can carry some like one or two properties that might not do as well or that have like heavy turnover and then you kind of top grade and you have a bigger appreciation play. Have you also found that, do you guys sell a decent amount of properties?
We try not to, but I think we've like, we're always culling the portfolio. That's how we refer to it. Like and it's usually like, I go to every turnover, just so I've like, I'm in the street, have, put eyes on the property and like turnover cash flow is like the murder, right? Like, you can have at least for us, 7-8 grand's a light turnover, 20, 25 grand happen. And that really sucks, right? And with some properties that we renovated a long time ago, the right business decision for the cash flow of the whole business is that instead of spending 25 grand on this rental turnover, we should spend 35 grand and make it a retail and sell to a homeowner and like harvest some off balance sheet equity, put a little bit of cash in our pocket, smooth out cash flow. That's just the business decision that makes the most sense. So we didn't sell much in the earlier years because we were so focused on like, we want to build the rental portfolio. I think we probably we did too little of culling the portfolio. I think like had I had it over to, do again, I would probably like make that part of the business plan is that, hey, I'm going to sell, if I'm building the rental portfolio 10 to 15% a year, I'm going to sell 3 to 5% a year and create a little bit of excess cash flow, get rid of some like tougher locations and just like build that into the cash flow model to smooth things out a little bit more. which is probably the math that we're doing right now, is we're probably selling like, I don't know, maybe I'm only selling like 2% a year. Like I'm selling 1 to 2% a year of the portfolio.
I love that advice for newer investors. I always had thought, and I've been investing for close to 15 years. I always thought like if I stopped growing the portfolio, then I could start realizing like all the wealth if I start like selling more than I'm purchasing. But if you're pumping all this money to build the portfolio, which is necessary, if you're wanting massive growth, it doesn't feel like you're like, dang, I feel like I should be like I'm doing pretty well. Like my net worth's growing. I'm not seeing it in my bank account. It's just like,
Yeah,
it's
on
this.
paper.
So yeah, on paper, it's like this safe bank account. And then so I stopped growing maybe last year and I was like, wow, this is like my cash flows are staying the same, even though I'm selling properties off and I'm finally like realizing all this. And throughout selling properties, I realized like that's when I was getting my big wealth chunks, like those properties that held for 7-10 years. And to your point, I think a lot of newer investors completely underestimate that turnover. I mean, you throw out some like eye-opening numbers of like, hey, a light turnover is 7 to 8. Where most people think like a light turnover is like $500. Hey, we just got to do some touch-up paint. In Baltimore, it can be. I've always thought that the turnover is the most important thing to like look at, because if you're getting like a turnover every year, you're not making money. You're going to be losing money no matter what your sheet says, because then people forget the lease up cost. I mean, you have the turnover, then you have like you're paying your mortgage or whatever you have, and then you have a lease up cost. So you're not making rent. Your expenses go up, And so,
you have that downtime, you have the turnover costs, you have the releasing costs. Yeah, and that stuff, like I did the math, like the math that we did internally. Oh, so just a quick story. So like I get there in 2007, we have 175 properties. We're not making money. We have 175 properties, making no money, actually losing a little bit of money on this portfolio. We're like, how could that possibly be? Like this makes no sense.
Yeah.
And so I'm like, I'm a finance nerd, and digging into the numbers, trying to cut this portfolio up, figure out like what's really going on here. And what we realized is we had two portfolios. We had a portfolio of market tenants. This is our experience involved. So it's just one person's experience. What we really had was two portfolios. We had a market tenant portfolio, which was about 80% of our units at the time. And those tenants stayed for 2.5 years on average. And we were getting murdered in that portfolio, like that we were losing a lot of money on that portfolio. And then we had our Section 8 portfolio, and they stayed for 4 years, maybe 4.5 years on average. And that portfolio actually made some money. And this it was a hard-earned lesson. Like, at the time, no one was telling us like, hey, this is what's going on. So like we realized that like, dude, that tenancy duration, man, that stat is like the stat. Like if you don't have, and so in my math now, like now having like crunched the numbers with that in mind, if you're not getting in my opinion, if you're not getting 3 years of tenancy duration, you're not going to make money in the business. So that's why the low end of the market looks really sexy on paper, on Excel, but in real life, it's really hard to find a situation where you're in a tougher location where the tenant wants to stay for longer than 3 years. They don't like it there either. Like you don't like being on that block, neither do they. They live like they're aspirationally looking to move out. So as a result, it's really hard to get, average tenancy duration above 3 years in those really tough locations. But when you move the up market, you get a little bit less current yield on the Excel spreadsheet, but you start getting 6 and 7 year tenancy duration to offset that. So, that's another reason that we've tried to move up market is that it's less drama. It's harder to make it work from a cash flow perspective. So that's always like your limiter, but it's less drama. It's more scalable. There's less maintenance. You can be pickier about tenant selection because you've got more tenants apply. You got more applications on those houses. So in terms of like trying to scale a rental portfolio, I don't know anybody who's got a big portfolio in real tough locations. You kind of get up to a number in those locations and then you burn out and start selling your portfolio off. Whereas the folks who have like migrated up market over time, is what I perceive to be the more sustainable approach.
Yeah, I love all that. I also want to add in there that I know you mentioned earlier, like, hey, on paper this. And it's so hard in the low ends to actually understand what the heck's going on and actually to pencil them out correctly, to be like, what is your vacancy cost on one block in Baltimore can be completely different on like another block in Baltimore. And it's just too hard and the metrics just aren't available. And so it's kind of like hit or miss for that vacancy rate. And you definitely need to put in, if you're in like rougher areas, you definitely need to bump up your maintenance costs, just your annual repair repairs. And then in addition to that, if you have a property that's like built 1900 build and you haven't done like a full renovation, you
Right.
better be thinking like, hey, these maintenance costs are going to be higher than that 1996 build across the street. And it's just, and not only is like the maintenance cost higher than that 1996, they're like more complicated. Stuff was like built differently. The contractors probably be charging you a little bit more. The way the pipes were made, it was like wax and hair and tie. And so it's funny. I mean, I say that's actually like how they used to like tie. They didn't weld the pipes together. They like melted like wax and horsehair and threaded the pipe. It's like a whole different kind of it's like frontiermen doing construction. And you're like, wow, I don't know how people did this. This is crazy.
Totally agree. Couldn't agree more.
For you said like when you took over the portfolio, 170 units, 80% of the units were market tenants, 20% were voucher. And you said that, did that switch because you guys started looking at that KPI and going, hey, we need to switch this over to like 80% voucher, 20% market? Or
exactly.
Where are you at today?
Yeah, we're probably 90-10, 90% voucher, 10% market. Even in our nicest locations, we still like working with the programs because your credit loss is really low and your tenancy duration is really long. For us, those are like the metrics that really make it work and keep the drama down. You also can't burn out your people, can't burn out your property management company, right? Like that becomes a factor, constant turnover in your property management is really exhausting. So so we shifted over the course of like 3 or 4 years, which was awful. Like it was an awful experience because we were forcing turnover. This was just sucking cash, like all those turnovers that we were actually forcing. But it was like, dude, we need to do this. Otherwise, the math is you're going to bleed out, right? Like we were doing the math. We're just like, if we don't do this, we'll be bleeding out and in foreclosure in 3 years. If we do this and figure out somewhere else to make money to afford to do this, we'll have a shot at like getting back above, getting to an actual stabilized portfolio that actually has some positive cash flow. Like we might be able to get to that inflection point. So it was a super painful 4 years where we had to figure out other ways to make money. So we were flipping. I mean, it ended up being we flipped and we wholesaled and we lent. And every dollar we made, we sunk into the rental portfolio to like affect this transition to a more sustainable portfolio. Got through by and by the way, it's 2008, 2009, 2010. So like and the world's falling down around us, and like no one's lending us money because the banks at that time. So it was a very, very challenging period, but we learned a ton. It forced us to be, to get better everywhere. So we worked a lot.
There's two amazing learning lessons right there that I want to point out. One of the learning lessons is like the first learning lesson is it doesn't matter how many units you have. Unit count does not matter. I find that what matters is NOI. Is like, are you making money? If you're not, like, you can have 1,000 units, just like you said, you had 175, you guys are barely. And so a lot of times,
it's a bigger problem. Yeah.
Especially newer investors get caught up with when other people say like, I have this portfolio, I'm like, oh my gosh, they're so far ahead of me. They're doing so well. It's like, if you just get like a few properties that are doing really well, you're going to be fine. Don't worry that as the other person doesn't mean that they're successful. Means they like grew. They probably hopefully they have some learning lessons. But the other one there was that location can be like your superpower. So if you like stay like super focused in like one area and you're not like, hey, I have a few properties in Baltimore. Oh, I got some few properties over in Cincinnati. I have a few properties down in Raleigh, North Carolina. You're never going to be a specialist in any of those. I mean, you might have like A players, but I find it really hard to purchase other places than Baltimore, even though I think the stats and the metrics are better. And I would rather purchase in like a Cincinnati or like a Dayton, Ohio. I like those markets better, and I think they're easier to operate in, but I already have everything built out in Baltimore. And so it's super hard. And it's also hard to know the markets really well. So even if you have like your trusted A players, you have some knowledge, they have some knowledge, and then let's like this, like, and you're not rebuilding a new team. And so it sounds like you guys have really cut your teeth in the Baltimore markets. Like, hey, nothing's going to surprise us. We know that the government's going to be pretty terrible. We know evictions are going to be pretty terrible. We know this about Baltimore. And so that thing that might scare other investors is like now becomes your superpower because you guys are so experienced and have some systems built around in one area. I just want to point that out for most people. Like, hey, if you stay focused in one area, it can be a superpower. And even if it's not the best area to invest in, you're going to be way ahead of anybody else trying to get into that market.
Yeah, if you price it appropriately, right? Yeah, we call that dumb tax, right? Like at different points in time, we've been like, why are we still in Baltimore? Like, why Baltimore? Like, when you see especially you see like in migration over the course of the past 5 years, going to all these other locations, the home price appreciation that those locations have experienced, like it's very tempting to be like, hey, I should go be deploying money in Tampa or wherever, right? Like,
yeah.
But you're gonna pay some dumb tax learning that market, figuring it out, like figuring out the nuances there, and in a tight market, which it's been with such low supply for the past 5+ years now, dumb tax is like hard to price into the pro forma, right? Like that, and so we've just been kind of scared. Like it's been the devil I know. Like I know how to price the operational risks of Baltimore, and so I'm just gonna be that guy because at least it's the devil I know. Yeah, have we missed out on some opportunities? Perhaps. Have I missed out on some paying dumb tax though? Also for sure, yeah. So depending on different people's risk tolerance, they talk themselves into different stories. But I'm a devil kind of guy.
Yeah, no, I love that. Would you mind sharing your buy box today? Like what is Dominion's buy box? What is Jack's buy box? What does a good deal look like for you in today's market? Like bedrooms, bathrooms, ARV, like purchase price, first renovation. Can you just walk us through what a good comes across your desk and you're like, we're buying it. We're adding it to the portfolio.
Yeah, rentals we're talking about?
Yep.
Yeah, cool. So depending on the location, so there's probably for the folks who aren't aware of this tool, I find that the Baltimore City produces a housing typology map. It's this company, the Reinvestment Fund, that does it for them usually about every 3 years. They'll refresh it, and it's basically it ends up the final work product is like a color coded map based off of most competitive housing markets to most distressed. So like ABC is your more competitive markets, HIJ is your more distressed markets. And so we have a different gross rent multiplier for different markets. I and J, I'm not really interested in buying right now. That's just, we don't have to at this point. So I'm just staying out of those.
Like Sandtown, Winchester, just really war zone areas. Is that what we're talking about?
Yeah, Mount Clair, Sandtown, Mill Hill, stuff like that. Yeah. The worst parts of McElderry Park, the tougher parts of McElderry Park, 400-500 blocks, all the skinny streets over in McElderry Park. So I'm staying out of that stuff. But then kind of and then we have basically a different gross rent multiplier max for each housing market typology, right? Just to make it very simple, it's, we're willing to be in for 60 times rent in an H, and then that number moves up and up and up and up until you get to a C, and we're willing to be into a C for 100 times rent. And then when we get to the county, we kind of grade the county based off of ARV. And again, it probably starts at 80 times rent in the lowest end parts of the county, gets up to 110 times rent in when you get up to your $300,000 plus ARVs. So it's literally just like a matrix. So depending on the location, we're using a different gross rent multiplier based off the quality of that location. So that's that's basically our target cost basis, right? So $1,500 rent times, or let's call it an $1,800 3-bedroom rent times 100 gross rent multiplier. My target cost basis is $180,000. So $180,000 minus repairs minus closing costs. That's my acquisition bid price. And then so based off of every house that we can get a look at, we run it through that matrix of gross rent multiplier times whatever the market rent is in that location, try to assess repairs, and then put a bid out. And so we're, valuing probably, a couple hundred houses a week to, make 30 offers to buy one. It's a big mining operation. And then we also have a limiter of I don't, just because there's a high rent in that location doesn't mean I still need to consider that refi, right? We don't want to. We'd like to be in for 70% of value, depending on the gross rent multiplier. Depending on the quality of the location, we're willing to start sticking money in to refis for a little bit better locations. So if I'm in the county, I'm willing to stick 5-10% into the refi. It affects, I have to take that into consideration in terms of the whole company cash flow. I can't only do that. because I'll run myself out of money. But, for like the more trophy, nicer locations, we're like, all right, it's cool. We'll stick 10% in the refi on that one because, cash flow is fine. And that's going to be a really nice one in 10 years, And so, yeah, that's really the method.
How do you have a like square footage price that you price out renovations? Do you do like light, medium, heavy rehab, like $25 square foot on the renovation? Or how do you process? So I love your processes, by the way. And you can tell that Jack, you can only grow so big unless you do like when you do things a certain way. You can't just be like willy-nilly throwing sticks on the wall. You can tell that Jack is very much like, this is what we do, 70% of the gross rent multiplier. And then, so how do you determine like how much you're going to spend on that, how much that renovation is going to be?
Yeah. So like everyone who does acquisitions for us has to be able to do construction estimating, right? Has to be able to walk in the door, go down to the basement, come back up to the kitchen, walk up to the second floor and be like 55. In a minute, they need to be able to come up with a number that's about right. Especially with the older houses, like using the per square foot is not bad. I have nothing against per square foot. I think they're like decent. I don't think they're good enough to buy off of, but like it's a decent starting point. Like it's a fine, it's a fine starting point from like pricing a wholesale deal. But like when I'm actually going to buy it, I need my guys to be within like $5,000 of that. Otherwise, they'll always be, we'll be buying too much stuff. I'll never hit my pro formas, right? Like, so we very much view construction estimating quickly to be a core skill set of a good acquisitions person.
Gotcha. Yeah. And there are, just to go in a little bit more in depth in there, I mean, in Baltimore, you can't always tell what the wiring is, which could be a whole rewire, which could, bump you up like $12,000-$15,000 on the renovation. And if you miss that, well, then you blew your budget pretty big. And so
it's hard on the older houses just particularly, right? And like and that's where we just pivoting real quickly to like the lending company, because we in our lending business we make fix and flip loans, RTL loans, and like that's a key part of that, right? And we're working off of pictures that somebody took, and not even necessarily in our backyard, like in Kansas. And so like the part of our guidelines is that prior to 1940, we get a little bit more conservative. Prior to 1920, we get a little bit more conservative. Prior to 1900, we're scared because like those are the ones that are money pits, right? No one ever tells you a war story about the house built in 1968 where their budget went from 50 to 100. That house was built in 1908, right? Like those are the money pits. That's where you go behind the walls and you're like you said, like, what the shit? This is horsehair and wax. Like this is all got to go. Like there's an oyster bed foundation. Like we have a problem. Like Houston, we have a problem. Like they're all the old houses. So like that the variability of budget is highly correlated to year built because of those changes in building construction. Totally agree with you on that.
Yeah, and you're just to kind of put a tie on that, you're basically saying like, hey, you got to have a little bit of experience in construction to know what you're, and do a little bit of a walkthrough. Are you finding, I mean, I often found that like, didn't matter what the property was, I was coming into like 35K when I used to renovate properties. It was just like, I would think it'd be like 30, or I think it'd be like 40. And I was like, I'm always coming in like 35K or like 40K. Like, I don't know why, just even if, it was like not that much stuff to do, and I always come into that number for some reason.
And that's
you find you have like a number, or is it such a wide range that
it ends up being like a number for the year built, right? Like when you're buying 1952 row houses in Dundalk, it's 40K. Like it's just for some reason it's always 40K. It doesn't matter how whether it was well maintained or a piece of shit, it's 45K.
There you go. You heard it from Jack. 40K is what you can use for your renovation budget. Don't know nothing. 40. It's going to be 40K.
Yeah, it's weird. It's weird though. It's like but that's like also because it's not the cosmetics, right, that drive the renovation budget. Like you're always painting the place, you're always doing trim. Like it's the mechanicals that really drive the budget cost. And we're almost always buying houses that have never been updated, right? So the what needs done from the mechanicals perspective, from the bones perspective, is highly correlated to the year built, to the building technology at that time. So I think that's the driver behind why you have these like certain year built, certain size, like that's the number.
That's such a huge, just to piggyback on you, it's such a huge thing to when you're saying mechanicals, Jack's talking about your HVAC. If you got to redo ductwork, he's talking about your I guess you're not talking about your plumbing, but you could be talking about like redoing all plumbing, but mainly HVAC and electrical are some big ones and your foundation. And if you can like, hey, these are going to be my like big costs. If you just know like your few big windows can also be like a big cost. And also if you have a huge building, flooring, I find is a monster cost. If you're just not thinking about it, and you're like, if we're doing everything LVP, I'm like, whoo, that's a lot of LVP and it's a big cost. And so you just need to know those monster costs. You don't need to know how much it is to do a little small patch in the drywall. That's not going to be your big one. That's kind of what you were saying is you need to know the big ones.
Concrete's the other one that's like the budget buster for us. Like the acquisitions guy pays attention to the inside of the house, doesn't look outside and like realize, oh crap, there's a tree in the backyard and all the entire concrete, the sidewalk to the backyard needs to be completely redone. And so not only do we need to cut that tree down, grind the root, dig the thing out, and then re-pour slab. And it's like, dude, you just said $8,000 of stuff right there. And that was for a sidewalk, right? Like, yeah, we found that like our concrete budgets were often missed too. Like that, like when we had budget overruns, we started doing closeouts, I don't know, eight or 9 years ago. And like kind of like postmortems on like, hey, we thought it was going to be 50 and it ended up being 61. What happened there? And it was like, dude, concrete was like the thing over and over and over again.
Interesting. Yeah, no, thanks for sharing. I want to hit a few final things on touching into the rental property before we go to the lending side. Rentals. So you think the best strategy still in Baltimore is BeVier strategy for investors, or, do you think flipping is a good strategy? Do you think the best strategy is kind of a combination of them both, as you alluded to earlier?
Yeah, I mean, rents are still strong in the city. In the Baltimore metro. So like, I still think it's like that's going well. The retail market, like selling to homeowners market, has softened over the course of the past 6 months. I think we've probably seen a little bit of nominal price drops over that period of time, but not so much that it's like putting anybody out of business. It's just not making quite as much as you thought. Mm-hmm. And the tougher locations are sitting for a lot longer. I think that the low end of the market has started to really soften. Like your gut rehabs in those like HIJ housing market typology areas are really racking up days on market right now. So I'm scared of that. I'm kind of scared of the high end of the market, scared of the low end of the market. But I still think that like the kind of 225 to 650 is like still solid enough that that's a place that you can flip, with certainty and create that current income. And then to the extent that you can find a deal where the numbers work and you can keep it as a rental property, we're still adding as many of those as we can afford to from a cash flow perspective.
Gotcha. So if you're starting from zero, are you flipping to build up cash and then putting rentals as you can, with being able to like recycle your money out of those deals? Would that be your go-to strategy starting from zero today?
Yeah, it would be wholesaling to build up a bankroll. Once you have a bankroll, and learn construction estimating and build a book of contractors, become an acquisitions person, because you have to have a source of deals to do any of this stuff. So wholesaling is still a great place to start. Build up a bankroll. Once you have 50 plus grand in your bank, maybe try your first flip, screw it up, learn a lot, go back to wholesaling, build your bankroll up again, right? No one ever gets through the first one clean. And then try it again until you're like, all right, I'm getting better at this. And then you start doing like a ratio of flipping and wholesaling. I need to make 50 grand, or I need to make 40 grand so that I can afford to spend 15, 20 grand in soft costs and sticking money in my refi so I can add a rental. And then it becomes like a ratio of like, all right, I have to do, 2 flips and, 2 or 3 flips and wholesales, and I can add 1 rental. 2 or 3 flips and wholesales, and I can add another rental. And you also have to feed yourself. So that ratio like starts to like over long periods of time, that ratio like starts to settle out where you can make, eventually 5 years later you can do 1 for 1, and then like 10 years later you can do 1 for 2. But like that's what our experience has been. That ratio has like just slowly shifted over a long period of time. But you got to start with the cash flow producing stuff, because you have to have a bankroll to play.
Are you guys still wholesaling properties?
Yeah, from time to time, yeah.
Awesome. You've mentioned a bunch of areas, so I appreciate that. But if you were like to target the best areas in Baltimore that you think you're going to see appreciation in, which areas would you target?
I don't know. We're kind of like location agnostic. Like we use that gross rent multiplier based off the housing market typology as like, that's our baseline. And then if a certain location ends up gentrifying or like getting a bunch of investment and prices go up there, like great. Like we had a bid on everything, so we're kind of buying everywhere. We're just buying everywhere at different prices. And then, so I don't have like a long-term view of any particular neighborhoods. I've been disappointed by, leadership in community development over time. And also, I just don't think that like city government can affect it as much as they would like to pretend that they can. Where when we've had significant home price appreciation in certain markets, it's been pure luck. Like I don't have like a long-term view on any. We're not trying to like chase paths of progress. We think you get too many like false signal in there, and there's too much failure in those like initiatives that I'm not putting my money behind the public dollar.
You don't have a gut feeling on any single one. You kind of do like a diversification play and just say, hey, if one of them does good, it's going to carry up the other ones. Hopefully the worst ones will just stay flat, and the best ones will carry the portfolio. That's what you're saying.
Yeah.
Is there any tech tools that you feel like have been like grossly important to scaling the business that you guys have used or are currently using?
We use Appfolio for property management. We use Builder Trend for renovation management. I still use Podio for inventory management. It's just a glorified Excel spreadsheet, but it's very user friendly and it gets the job done. So nothing like groundbreaking in any of those categories. We're pulling comps off of the multiple list. I use that housing market typology map as a guide, so I think that's a really useful tool. Baltimore City's got this tool called Code Map, which the housing market typology map is on there as a filter. So I find that's a very useful tool. Like have Code Map up and you can type the address in and it'll immediately tell you, all right, this is in a G location. And then I can run the math off of that.
I'll put the link to that typography map. If it's the same one that I'm thinking of, it's not that intuitive, those filters. They are kind of hard to like figure out certain things, but they also have some really awesome things where you can find like which properties are owner occupied, which ones so you can figure out like, hey, this whole block is owner occupied. It's none of them are rentals, which is I find kind of beneficial to be like, hey, if I'm going to purchase that one and have a rental, there's going to be less crime on an owner occupied block than ones that are not owner occupied. And there's all rentals on this. And you'll find that in the city, they'll be lumped together.
Yeah. That's a great situation.
Is that the same? That's the same map you're talking about, right?
Yeah. They've got a bunch of different layers on it. Yeah. That owner occ is one of the layers you can turn on. Yeah. It's a great tool. Great tool. You can also like see like where like vacant building notices are, where citations have been issued. They have a bunch of different layers on there that are whatever rabbit hole you want to crawl down.
You click on the property on the map to find this is very granular, but you click on the map to find citations and violations, because I always use like a different citation violation of Baltimore. You type in the address, which is very touchy, and sometimes it's really hard to find the actual address in there. It's like just not a good system. You're saying
you can click on the address and the little box will pop up, and there's like a link to citation and violation search.
Okay, so it goes over to the site that I just automatically use. Gotcha.
And but they color code it. There's like some color coding, so you can see it like you don't have to click into every single one. Like it'll say like, hey, there's a vacant building notice on this property, and you can see it in a visual format. Oh wow, the block over has got like 5 vacant building notices. You don't have to click into each property to see that. It'll give you some little like blue square, red triangle, whatever.
Yeah, no, I love that. Yeah. If you're coming to Baltimore, other than reaching out to you and Dominion, is there anybody that you feel like investors should really know coming into like the Baltimore market as like a new investor?
I mean, the Maryland Investor Network on Facebook is a really great resource. Brenton Hess took over that from Mark Owens a couple of years ago, and he's really made it a thing. He's really made it a place. So I'm a big fan of Brenton and what he's done with that group. He runs it well. He runs it with integrity. It doesn't become like a shit show. It doesn't become a bunch of just like crappy wholesale deals or just vendors just spamming the board with advertisement. There's actually like a community that he's put together there. So I think that's a great kind of virtual resource for getting your bearings, not only in Baltimore, but Maryland in general.
Yeah, love that. We'll put a link to that in the video comments. Switching over to lending, if you can just kind of share what Dominion Financial Services is, what products they have for investors, and how like a newer investor would use Dominion.
Yeah, absolutely. We're a business purpose lender, so all we do is lend to real estate investors. We have fix and flip loans, which the industry is now calling RTL loans, residential transition loans. Basically, it's a fix and flip loan, even if you're going to keep it as a rental. So like they try to do something that's more generic. So RTL loans are the short-term bridge loan that often has a construction component to it, or small construction and rehab holdback associated with it. And then, so we do those, and we do that nationwide. So those are like 12-month loans, 10-ish interest rate is like typical these days. A point we charge actually an exit fee as opposed to origination fee. It's really just a marketing thing, but it's a little bit less painful to pay your fee out of the profits than it is, upfront when all the other costs are being paid for. And then there's a couple grand of junk fees to basically allow us to originate that, pay for the origination of that loan. They're like 8 to 12 month terms are typical. We do pretty high loan to cost on that. So we do have, you can get 100% of the purchase price, 100% of the rehab as a loan amount from us, as long as it's no more than 70% of the after repair value. So we're trying to not punish deal guys for getting great deals. That said, if you're doing a little bit skinnier deal, you might have to put some cash down. So that's totally typical in our book as well. So that's one product. We've been doing that since 2002. Rates and terms have changed over time, and we've gravitated towards the more experienced fix and flip investors as kind of like our core, who we want to lend to, who we're the most aggressive with. And then we also added the DSCR loan as a product we started doing it in 2019. It became very popular in 2020 because rates got very attractive, and really have been taking business away from the local commercial banks who used to be the source of long-term financing for investors who are building their rental portfolios. And as rates have become competitive with banks, you might get a better deal from your credit union. That's probably the credit unions are still probably priced a little bit better, but they're only offering 5-year loans, whereas the DSCR loans are 30-year loans, which I'm a huge fan of. We're only borrowing DSCR money for our incremental properties right now. I just like that 30-year fixed rate option. I think it's, frankly mispriced in the market in the investor's favor. Whereas the credit unions are going to retrade the deal on you every 5 years. And if interest rates go up like they have gone up recently, all of a sudden, all of my bank loan resets have gone up significantly. Whereas my DSCR loans I'm locked in for forever on those. So anyway, we do a lot of DSCR loans. It's an easy, quick underwriting process. Loans close in less than 30 days. The holdup is typically the appraisal and the title company. And we originate those loans, and we end up selling them to insurance companies and securitization shops. And a nice thing about the way we've set that program up, which I think is very much in the investor's favor, right? This is how we wanted to set it up for us, basically, right? Hey, if I was to want to work with a lender, what are the things that are important to me? And the main thing that I'm interested in, service is table stakes, right? If you can't close my loan quickly, buzz off. You're of no use to it. So that's table stakes. But once I know that I can get my loan closed quickly, I want to be able to know that I'm getting the best deal out there. And I don't want to go spend my nights and weekends shopping 12 different lenders to make sure I'm not getting taken advantage of by somebody, right? This is a very opaque market to me otherwise. And so, I'd rather be spending time with my family than shopping 12 different lenders and making sure that this particular broker isn't just steering me where he gets paid the most, right? So what we set it up is that we're counterparties with, there's basically 12 different DSCR loan buyers. We're counterparties with all of them. And the way we work is you give us a scenario, and then we feed it through a pricing engine, and we're product D is going to be the best for your particular scenario. The backup plan is product F, and the backup plan behind that is product A, but it's going to be a little bit more expensive if you go to each of those. So you're getting the benefit of working with a broker, but we're direct to those insurance companies. So you're not having to pay for a broker. So we think that that's the idea, the model that's going to win out in the long term, because this has become a very commodity product. So, and for our core customer, price matters, right? I want to know, when I'm borrowing money, I want to know that I'm getting the best deal. So anyway, that's how we set ourselves up, and it's been working well. We do about 300 loans a month all over the country. We lend nationwide, and we do a lot in Maryland, of course. It's a big state for us. Yeah, that's our business.
Love it. Is there a recommended title company that you're this title company is the bee's knees?
No, not really. We probably work with 4 or 5 different title companies. I think there's a bunch of great ones, and a bunch got weeded out, as volumes slowed down in 2022 and 2023, some folks got weeded out. So, and there's been a bunch of title companies that have become really strong in terms of servicing the investor world too. 10 years ago, it wasn't quite, there was a couple and they didn't really like investors because they'd rather be doing the homeowner refis. No, I think we work with 4 or 5 different ones right now.
I was trying to make you throw a bone out there for a title company, but I get it.
I'm not gonna. No, I can't play favorites. Too many. Somebody yell at me.
No, it's always. I always like to have a few resources that and new investors that are coming that is hey, I listened to Jack and Dave. I'm going to go with Dominion. Jack threw out the title. And so it makes it like, it greases the wheel of like, okay, they've laid out the path for me. So that's why, that's why I do it. But I totally get it.
Now we work with all title companies. So choose your favorite title company. You tell us who you want to work with. We're not going to say, hey, you need to go work with so-and-so. Like, you work out a great deal with them. You make sure the service level is excellent. The pricing is excellent, and we will work with them.
Yeah. And I'm sure if you're working with one of the mortgage brokers over there at Dominion, they can probably steer you the right way. You just ask, hey, what's a really good, like, low fee title company that you guys work with that really make it easy? I'm sure you guys will be able to give one or two recommendations. I wanted to throw this one to you. If you could only have the rental company or the lending company, you only can pick one. You're starting back over from zero. You get one company to be at. Where are you? Which company you're starting?
I would say you have to. I'm gonna be that pain in the ass guy who like refuses to answer your question, but like, you have to have something where you make current income so that you can afford to build a rental portfolio. Like, I can't see that someone can do just the one thing. Like, if I tried to just build a rental portfolio and that's all I wanted to do, you're going to run out of cash. Like, you're just going to run out of cash. It ain't going to work. But if you only do the lending business, you are going to pay a shit ton in taxes. So I don't like that idea. And you're not going to build any long-term wealth. You're going to be as good as the last 12 months of origination activity, right? There's no long-term net wealth building there. But man, putting the two together is what I really like, where you're making current income so that you can afford to build the rental portfolio. You bonus depreciate the rental portfolio so that you can offset your current income on the current interest and fee income, which is taxed at the highest rate. So I get to use the depreciation from the rental portfolio to offset my interest and fee income in the lending business. And over a long period of time, the rental portfolio builds up a big chunk of wealth, and you've paid a lot less taxes along the way. Like, putting those two together, putting some current income producing business alongside building the rental portfolio, that to me is like the combo that works. And I've seen a lot of people be like, I'm going to do this one thing because it's hot right now. And it works for 3-ish years. And then the market turns and it becomes really, really hard to do that thing. And they got nothing to fall back on, and they burn out or blow up. And so I really like the idea of, it's in the vein of multiple stream sources of income. But the thing is, the skill set's all distressed real estate investing, right? It's all distressed single family real estate investing. That's the skill set. You can apply those skills to 8 different business models. With whatever you want to do, whatever you feel like doing. You want to be a property manager, cool. You want to do full-time leasing, you want to be a real estate agent, you want to be an appraiser, whatever. Pick your poison. I don't care. As long as something is current income and something is long-term wealth building, and put that combo together. And there's all the success stories that I'm aware of are some combo of that.
Yeah, I love that answer a little bit. I love that answer a little bit. You're talking about like a wealth multiplier, which is awesome. It does sound, if I'm going to pick what you said apart, it does sound like the rentals is more of like the in game. And if I'm actually reading between the lines, it sounds like you have to have the rentals in there. Because if you don't have the rentals in there, you're just paying a ton of capital. The rentals are building long-term wealth. And there's no right answer. This is not like me.
Yeah.
That was a Dave Hathaway curious question for you as the interviewer of like, hey, you have one or the other. I've also seen more recently investors with semi-sizable portfolios, definitely not 850 properties, but I've seen them go sell my portfolio. Some people that we know in common, no names out there, but sell off their entire portfolio and go into hard money. And that is there. And so it's interesting when I see that, and I'm always just trying to say, okay, what is it's the progression. I like investors to know like, hey, this is a progression. I mean, personally, I'm investing in a lot more alternative assets and syndications and stuff in addition to my portfolio. And I feel like not very many people do that. And I'm like, oh, am I just an idiot? And I'm just going to lose all my money here. But I see also other people going into the hard money route. I definitely see the progression of investors as you've discussed that you do. And I have actually done is that top grading properties. So I just like people to be able to see ahead in the game and be like, okay, they're a little bit ahead. Could I do this quicker? I hear a lot. I would have top graded my properties quicker. I wouldn't have purchased as many Warzone or only focused all on cash flow. I do hear that. I think of that as myself. And so just trying to show people kind of like, hey, this could be what it could be down the road for you. And you can maybe speed up your wealth building by doing X. That's where I was going. We're angling with that one, Jack.
I mean, I really do love the private lending space as a lifestyle business. I don't think there is any better lifestyle business than having $5 million on the street and like talking to investors all day, going out and checking out deals, cutting a loan deal with them, and then having, an assistant in the office who manages your book for you. Like pound for pound in terms of like money made per hour, I don't think there's anything better. The problem with it is step one, make $5 million, right? Like that's
I got him going. I got the juices flowing. I got to come out and say, no, step one is the hard part of building the wealth. And then it's like, and so like wealth mindset, I think of like, well, where is your mind at when you've built the wealth? How are you conserving it? Are you continue to build a portfolio? Because in my mind, when I'm thinking and I'm talking to my 80-year-old self, my 80-year-old self's like, hey, Dave, I don't want you to own 1,000 properties. That sounds like, what did you put us through? And if you die, your wife's better have like a really good consultant that's going to be able to be like, how are you disposing of these 1,000 properties? And so there's a little bit of that in my mindset of like, and what you're saying is private money. It's almost like you get the benefits. You don't get the depreciation of the tax advantage benefits,
right,
but you get the benefits and not doing the hard work that comes from actually building portfolio, which is what I feel like a lot of people are like, hey, I'm done managing properties. It's like stressful. There's stuff going on all the time.
Yeah. The thing is, what people underestimate though is that just the work that time does for you on the rental portfolio, right? Like if you have $10 million of rental real estate, you make 300 grand a year of appreciation doing nothing, right? Like, that's 3% a year. Like you make, and no one, it kind of doesn't matter if you have cash flow, right? Like you need cash flow to make sure you pay the mortgage. And as long as the mortgage payment's getting paid and you're getting paid down over time, great. You're making a 7% return on the money that's being invested in amortizing the debt. Separately, you have an inflation hedged asset that is growing at whatever, call it 2-3% a year. It's been much higher recently, but call it 2-3% a year. And that wealth building is completely tax free, right? That's $10 million of real estate. I'm just picking a number, right? That's 300 grand. That's completely tax free and completely tax free and completely passive, right? So if you can get a setup where it doesn't suck you in and you don't, where you actually have a property management so that it was really important to us to like get the rental portfolio to a point where we could afford a staff, where we could afford a company to manage our portfolio for us, because the in between is hell, right? Like that purgatory really sucks, like between 20 and 250 is kind of a problem, because you can't afford like super professional staff to manage it the way that you would. So you're at some level still sucked into the decision making. So like, it's a slog, right? Like that middle ground is really tough, unless you've found some like magical property manager that, I don't know, they're super hard to find, few and far between.
Unless you found a unicorn that doesn't exist, Jack. Especially if you have properties that are like in C-class areas. Some of the property managers would just say, I'm not managing your properties in that area at all. I'll manage these ones over here in Fed Hill. Thanks, guy. Those actually don't need managing.
Those are not the ones I need.
Those
I'd love to
like
10% of your rent over where you're not working and spending your time. I'd like to dip into your pocket and grab 10% of your rent. No, dude, that's where I don't want them. I'll keep those.
Yeah.
But if you can get it to the point where it actually is a passive thing, then the wealth, that's where the wealth creation comes in, right? Like that 3% is a compounding number. Like that is, you can really build a lot of wealth over there. Whereas in the lending business, the private lending space, you have to keep that money deployed and you need to be managing risk constantly. And you're not, from an hours spent, it's not as high, but you don't get to retire, right? Like you get to retire when, you decide on a year's notice, all right, I'm not making any more loans and I'm just going to wind down my book. But until then, you are working. You're not working 60 hours a week, but you're only as good as your last 12 months of origination.
Yeah.
So,
It's very much
no free lunches anywhere, right?
It's very much chicken or the egg, or like A, B scenario too. You can't do hard money lending without having the net worth or the wealth, the capital to deploy. And it also gives you like a whole bunch of experience building that portfolio, right? If you haven't built a portfolio, how are you going to like understand how much the renovations are going to cost? There's a hard money lender that's like growing really fast right now. He's never had any rental properties. And I was chatting with him over the phone. I was like, how are you like determining the renovation costs of the properties? He's like, I'm like, and I assume he's just looking at like what the investor tells him it's going to be. I'm like, and he's like eliciting like capital, and I was like, he said the worst case scenario was like a house burned down, insurance paid for it. And he's like, oh, it's my worst case scenario. I'm like, I actually don't think that's your worst case scenario. On the phone, I was like, I actually think the worst case scenario is you taking back the property via foreclosure, because you don't know, like, unless you can just dispo it and sell it and it's gone, you're gonna have to renovate it or do something. And if you don't know how to do that, well, welcome to your Jack BeVier's thumbtacks. Welcome, because here they're coming for you, and then you're going to realize what was like painful.
Yeah. Your worst case scenario is screwing up the draw process and releasing money that didn't add value. And then getting tossed the keys 75% way through and realizing you need to rip everything out. That's your worst case scenario.
Interesting. Yeah. No, I'm always weary unless the lenders have a little bit more experience. I have two more questions. One is, any advice on partnerships? You have some definitely experience there. Just like whatever advice you can give for like being in business with a partner, or how you find a partner, or yours was unique.
Yeah, mine was unique. I don't think mine's like the most. I got lucky. I got very lucky. I happened to meet a guy who was interested, and he's been a fantastic partner. He's been my mentor. We're very much aligned from a values perspective. So I've been very fortunate to I just got lucky and to have a great partner. At 23, I had no business, making that decision, but it just worked out. I mean, you're getting married. You're getting married. That's what it is, right? Like the wrong partner can cause you as much pain as the wrong marriage. Wrong business partner can cause you as much pain as the wrong marriage. So at 23, I had no business making a decision about a wife, but for some reason I thought that a business partner was within my purview. I was wrong, but I got lucky. I would say that like my advice on the business partner thing is that everyone gets excited about business partners because of conversations about upside, right? There's some opportunity that they can't quite do themselves. They need another tool or another piece, another person who's going to be able to make that work. And everyone gets really excited and focused and goes and has beers and talks about upside. The whole time they talk about the opportunity and the upside. What they should be talking about is the downside, is that if this goes sideways, how's this going to go? Like what's your personal situation in terms of when this goes poorly, how much time are you going to be able to commit to it going poorly? Are you going to be able to work nights? Are you going to be able to work weekends? What are the resources you have to bring to the table when this goes poorly? And no one talks about that shit. Everyone signs LLC agreements thinking about the upside, and they don't consider the downside. They're just like, people put it out of their brains. It's not going to happen because they can't conceive. They're so excited about the upside, they can't conceive that there would be downside. But there very often, almost always is, especially if you're partners for long enough, there will be. And so I think that if people focused on the downside and got into more of like core values conversations and really got personal about, like what can you bring to the table when shit hits the fan, or what are you gonna bring to the table when shit hits the fan, they'd set themselves up much better in terms of their partnership agreements and operating agreements, but also would backtrack a much higher percentage of the time than they do. I was fortunate that I jumped in to Dominion in 2007 and then experienced 4 years of downside. So at the end of the 4 years, Fred was like, yeah, this guy's ride or die. Sick. But I could have bailed, right? Like that shit was hard. No one was making any money. So like our partnership got tested immediately out of the gates. And then it's been super strong as a result of that. But that was, not typical.
So my takeaway was two things. One, make sure there's value alignment, like for sure, like that your guys' values, character is similar. And then two, talk downside. Like, what is the downside here? What happens in this worst case scenario? And are we okay with that? Cool. I
Yep.
love that advice. I'm actually really glad I asked that question. That might actually be the golden nugget out of this entire thing for somebody, for real. The other question is, and I see this, it makes me sad for smaller business owners. And I think a lot of people make the assumption that most business owners that are successful are like super wealthy, and that they are super wealthy in a cash flow perspective. And I don't think that's always the case. And I'm wondering how you think about like drawing a salary as a small business owner, and what's your recommendation to other small business owners? Is it a percentage? How do you decide how much you're going to pull from the business to
Yeah,
support
yeah.
yourself?
Related conversation to the partners thing too, right? When you have partners that have different current cash flow needs, and their spouses have different expectations for how this is going to go. You need to have those conversations before you sign the operating agreement, right? Like, what's your spouse think about this situation? Are they because they're kind of along for the ride, right? You can't avoid the influence of pillow talk, in business. So,
Yeah.
I mean, our perspective, and that was one of the things that was like, I was fortunately aligned with Fred, was that we were like, only take out the minimal that we need to live, and neither of us are spenders. So Fred was driving a Highlander. I drive a 2012 Prius still. Like, we're just, the perspective that we came into the business was that the money's going to stay in the business to build the business. And that's the highest and best use of it. It is, our cost of equity is so high, and the opportunities are so interesting that taking money out of the business would be a real shame, right? Like, spending that money would be a real shame, because the compounding effect of keeping that capital in the business, what we could turn that cash into. For us, it was like, there's nothing that I want that is like worth spending my operating capital on. I'll make so much more money if I leave it in the business. So we were fortunately aligned on that, and we've only taken out literally the minimal that we need. I mean,
Is
today
that what you'd recommend for other business owners that have a business currently and they're growing their business? Is it always just take out the minimum? And is that some sort of percentage? I mean,
it's hard to, when
no,
you're
there's no,
capital constrained, like when
yeah,
you're small business and you're capital constrained, like taking out big salaries is really, really expensive. Like, the cost of equity when you are that pre-seed round, kind of style business, like the cost of equity is so high that like better be a good damn reason that you're gonna take money out of this business. And but hey, like, if that's, by the way, I'm overlaying my goals and my values here, right? Like,
yeah, no, I mean, that's
your goal is
what
to
we're
have a
trying to
lifestyle.
get. We're trying to get your goals and your values, your experience. You built something great, at least from the outside. Great. I don't know how it feels from the inside. Built something impressive, I'd say.
Everything's
Would be built something that most people have not built, or might not even can fathom. And so understanding where you're coming from, how you did that, how your mindset is really important. And we get that it's coming from you. We're asking it from you.
Yeah, yeah. So, like, from my perspective, that was what we did. That was what we did. It was important. We didn't, and since cash flow is such a difficult part of growing real estate business, that we would be the source of cash flow leaving the business for, I don't know, because we wanted to buy a nicer car or whatever. Like, is just, it's just incongruent with the way that we ran the business. We were like worrying about, we were picking up nickels, pennies and nickels at work every day, and we're going to go home and spend quarters. Like, it's just incongruent with how we lived our lives, right? So, I mean, I still drive a 2012 Prius, and we're still growing the business, because that's where our, that's the joy, that's what the fun is for us.
Yeah.
Somebody else might come to the business and be like, hey, I want to build a nice lifestyle business, and I think I'm good at some certain things here, and I need to pull out a couple $100,000 a year to keep my family in the lifestyle it's become accustomed to. That's fine, but you're going to have a very different business and a very different growth trajectory as a result of that. And that's fine. There's no dig on that. It's just, don't think that you're going to build this thing, operating it like that. You're just not gonna.
Yeah.
Math.
I mean, that ties into like, what does your future look like in real estate? Is it just continuing to grow Dominion or not? Or like, where's your future line in real estate?
Yeah. We just like doing this. We're just having fun. So we've been growing the lending business. We've been growing the lending business a lot. And we're going to keep pushing there. We want to, we're a national lender, and we want to be, keep crawling up the ranks of the national lenders. Like, we like competing with Wall Street. We like competing with hedge funds and private equity groups. And nobody told us that, like, we're just a couple of guys who, from Baltimore who used to drive around the hood. So we just enjoy competing, and that's what we're going to continue to do. On the real estate side, and we're still real estate guys. We like buying houses and renovating stuff. We started to do some bigger projects for us, which is like, a 20 unit, a 28 unit, a 45 unit multifamily building, which is really big for us because it's hard, and we're learning new stuff, and we're paying some dumb tax because of we're learning new things, but that's what keeps it interesting. So, I think that we're just going to continue to try to challenge ourselves, and we get bored, like when things are stable for a year or two, like we get miserable, so it's just, that's just us. Like we have to be pushing in order to find joy,
Nobody ever lost money from a shiny object, Jack. No one ever lost money from a shiny object.
Yeah, shiny objects, we check each other all the time. I'll come in all jacked up about this thing, and I'm like, this is the future. And Fred will check me, and then he'll come in with someone, and I have to check him. But when we both get excited about one, we're like, all right, let's do that. Like, so it still happens.
For Dominion Financial Services, it lends. I mean, this is good. I mean, we're kind of done. We're wrapping up the interview, but it lends in all states, correct? Or is it only? I mean, is it 48 states?
Yeah, in all states. We actually just pulled back from Nevada because you have to have a physical presence in Nevada. Mm-hmm. So we're not in Nevada at the moment, but we'll find a loan officer there sooner or later, and we'll be back there. But yeah, 49 states.
49 states. Awesome. Best way to reach out to you, to Dominion, if people are looking. And I also is there anything else like the property? Do you guys manage only for yourself? Do you manage for other people? Is there?
Yeah, we only manage for ourselves. We have a couple of turnkey rental investors from 15 years ago, but we haven't taken on any new third-party property management in 15 years. So it's really just for ourselves. But yeah, if anyone wants to reach out to me, my email is jack@thedominiongroup.com. Love grabbing lunch, love talking shop, so don't be shy. I eat lunch every day, so don't mind sharing the table. And then my cell phone's 410-353-5667. So.
Awesome. I'll put it all in the show notes, so you guys can just go down there and find all Jack's contact information in the comments. If you guys have questions for Jack, for myself, put them in the comments. I mean, I'll reach out to Jack, make sure he's on it to respond to you. And again, Jack, thank you for your time. Thank you for your experience, expertise. I appreciate it big time.
Yeah, no, I really enjoyed it. Thanks, man. That was a lot of fun.
Awesome. We'll see you guys on another episode of the Real Estate Hacker Show.